at 8:32 this morning, and would Dan like to lead us in the pledge of allegiance?
I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
Okay. Any public comment? None. Okay, next is the consent agenda. Does anyone have any comments on the minutes, the April retirement report? Let's see. The preliminary monthly financial report for February or March. Okay, moving on. Discussion and possible action regarding investment matters. Good morning.
Good morning. How are you?
We're fine.
Great, thank you.
Yeah,
Good to see you all.
happy to see you.
So, Claire and I have a fairly light agenda for you today. Today we're just going to talk about first quarter performance, and it was good. But to give you a preview about what we're working on behind the scenes and we'll be working on with you in the coming months, just wanted to let you know that next month we plan on coming up here and talking to you about a few asset classes you might want to consider in your upcoming asset liability study. And those, so it'll be an educational only session. And the three asset classes we're going to talk about are private equity, infrastructure, and then real estate debt. So it's going to be educational only. It's going to be Claire and two of our specialists. I'm actually on vacation that week, so I'm going to miss it. But we're going to have our private equity and then the infrastructure and real asset specialists come in and talk about those topics. The meeting after that, or 2 meetings after that in August, we hope to have the AL study to talk to you about. We're currently collecting the necessary input data from the actuary, and we're waiting on a few more data points, but that's a key component in the asset liability study we're going to conduct. One thing we talked about last meeting was what are the key inputs going to be in the AL study. And Lee, we talked about the fixed income, real estate fixed income, private debt, and whether or not that's a component to the AL study. And I just wanted to clarify one thing I said before. We use these broad asset classes as building blocks, and we need our capital market research group to have big picture return risk correlation numbers in how we come up with the asset liability study and model it. We don't have that for private real estate debt because it's a comparatively narrow component of real estate or debt. We look at it as broad asset classes. So what that means is when we do the AL study, we won't have it as a building block. That doesn't mean you can't invest in the asset class though. What it means is that if you want to consider that as an asset class, we just do it in the next step when we talk about, okay, now that we know how much we want in real estate or bonds, how do we put in real estate debt within real estate or bonds? So I told you something last meeting, which was, okay, yeah, we'll put it in the study and model it, but we don't have it as an input to put it in the study. So we'll just look at that at the next stage of the process after you do asset liability study, then you look at each asset class and you say, okay, how do I put this real estate debt in if I wanted it? Okay, so just wanted to clarify that. So, yeah, so that's our work plan and what we're doing. So today, we're just helping you with the monitoring of the investment program. And part of your fiduciary duty is not only setting up asset allocations, selecting managers, but okay, how are we doing? And that's the only purpose of the discussion today. Okay, with that, I'm going to flip ahead to our summary presentation. Hopefully you have it on your iPads. And I'll flip ahead to page 2. And here, I'm going to walk through and talk to you about what happened in the capital markets from a big picture perspective, spend a few minutes on this modern monetary theory that just kind of an aside. And then Claire's going to talk specifically about your portfolio. Okay? So, big picture, up until the last few weeks, it has been a really strong environment for capital markets. Recall fourth quarter was dismal. It was awful for pretty much any risk asset class. And almost immediately after the turn of the year, capital markets started roaring back. So why was that? In large part, it was because the market decided, well, the Fed isn't going to kill the expansion, and it's going to not increase interest rates, and the economy is going to continue to grow. So the big fears that were weighing on the market in fourth quarter, the Fed, went away. So that meant that any asset class affected by the Fed and increasing interest rates took off. So when we look at performance, you'll see that US stocks, international stocks, and even bonds all did well. So most of the time when you see stocks and bonds both doing well, it means it's a liquidity event, it's that the Fed Reserve is doing something. Because most of the time when you hear this risk on, risk off environment, stocks do well, bonds do poorly, most of the time they move in opposite directions. But in this quarter, they all moved up, and in large part because of expectations with the Fed. GDP growth in the US remained strong, 3.2%, which makes you scratch your head and wonder, well, why is the Fed talking about not increasing interest rates, and why today do people think the Fed will actually cut before year end? And part of it had to do not with just the headline number of strong GDP growth, 3.2%, that's a great number. But it had to do with, if you looked under the data, about, okay, why did we have 3.2% growth? A lot of it had to do with restocking inventories, which you kind of only do once. That's not necessarily indicative of future growth. And consumer spending was slowing. So the Fed was looking past the most recent number, looking at underlying data, saying, okay, this economy may not be quite as strong as you would guess from 3.2% alone. In addition, we saw weakness in Europe during the quarter from a growth perspective, as well as China. So the largest economic blocks were looking a little weaker than had been anticipated. If we flip to page 3, you'll see here that this is showing returns for the quarter, year, 5, 10, 25-year time period for broad markets. And here you'll see for the quarter, US stocks were up about 14%. Really strong rebound. International stocks were up 10%. Bonds were up about 3%. And real estate was up about 2% for the quarter. So, real strong rebound. Now for the year, stocks are up a great number, about 9%. International stocks are disappointing. You'll see they're in negative territory. And part of that has to do with slower growth, but also a strong US dollar. And then bonds are up about 4.5%, and real estate up about 7% for the year. Over on the left, you'll see that there are a few other observations within the market. Growth stocks outperform value. Small cap for the quarter outperformed large cap. And China did particularly well with emerging markets. High yield bonds outperformed aggregate bonds. So with these few data points, we know your portfolio performed well because you have a lot of exposure to US stocks, you have a lot of exposure to international stocks, your active managers are overweight growth, and your bond managers are overweight credit sectors, indicative of high yield outperforming. So from these few bullet points, I'll tell you in the quarter you outperformed, and you probably look really good relative to peers. And you'll see that actually when Claire gets to the data. The next a number of slides give a lot of detail about what happened within each market. But let's just flip ahead to page 9, because most of it reiterates the stuff that I mentioned from the summary page. And let's spend a few minutes talking about modern monetary theory. Wow, this is a weird segue, isn't it? So every once in a while, James will send us a note, say, hey, can you bring this topic up? Because we've been seeing a lot of it in the press. And it's something you're probably going to be hearing about, especially through the election process. And it has some implications on economics, which have implications on capital markets and the performance of your fund. So you may have heard some talk about this thing called modern monetary theory. Well, actually, let me ask, has anyone heard of this before? Does this ring a bell at all? Mm-mm. You got to be a little bit in the weeds to hear it, but I promise. So maybe it's not as interesting as I thought, but you probably will be hearing about it going forward. How about this? Have you heard of the Green New Deal?
Yeah.
So the Green New Deal requires money. You got to pay for the Green New Deal. How do you pay for it?
With a modern monetary theory.
And actually, AOC said once, well, she was asked, how do you pay for it? And she said, modern monetary theory. This is the way we pay for it.
Isn't this also the way we paid for the wars in Iraq and Afghanistan by not putting it in the budget?
It's the way you pay for everything. And one interesting thing about modern monetary theory is people from both sides of the aisle could come to the same conclusion about it if they want. And some economists can come to the same conclusion about it if they want. So it's a very tempting theory to think about if you're a politician, and it's a powerful tool if you're an economist from time to time at the right time. Okay, so what are we talking about? From a big picture perspective, we have a Federal Reserve which has a dual mandate of full employment and controlling inflation. And what they do is they increase and decrease Fed funds rate to control those two things. It's kind of a blunt tool they have, but that's what they do. What if we had that all wrong and say that the central bank is not supposed to do that? Control inflation and maximize unemployment by moving interest rates up and down. What the modern monetary theory economists say is that the Federal Reserve should actually keep interest rates at zero and get out of the way. Just make debt as cheap as possible and get out of the way. And what you do is you adjust the budget And taxation, those two things, to put money into the market or take money out of the market. So if you want to stimulate the economy, the government spends more money. If you want to slow down the economy, tax people more, right? So those levers controlled by the Fed should be controlled by the legislature. And on top of that, all economics should be purpose-driven. The purpose of the economics and what we all do should be something that has to do with people at the end of the day. James is an economist, he can talk more about the details of this, but it's a line of thinking within economics that says economics should be purpose-driven. It's not an academic exercise. So this purpose-driven philosophy says, well, we should be doing this to make sure economics is fulfilling our objectives, whether that's full employment, right employment, or a green, the Green New Deal, right? So I mentioned that both sides of the aisle might like this argument because I mentioned spending and taxes, right? So one side of the aisle doesn't like taxes, stimulate the economy with lowering taxes, and then the other side of the aisle might, in a stereotypical world, like spending, right? And stimulating the economy through spending. So another premise of modern monetary theory is debt doesn't matter. So most of the time when we hear this, guns and butter, I want both guns and butter, you worry about inflation or you worry about debt load. What modern monetary theory says is if you control your own currency and you have debt, just print more money, right? So the US Treasury issues debt, you need to pay it back, well, just print more money and pay it back.
Did Paul Krugman dream this up after eating a lot of ice cream?
So Krugman thinks this is baloney.
Really? Of course.
Yeah, he's one of the active voices against it. Summers thinks it's baloney. So there are mainline economists who look at this and don't agree with it, on the right and the left. So this is very much on the outside of the mainline.
This sounds like California.
Well, California doesn't control its own currency. So this applies specifically to the federal government who can control its currency, right? So it's a really interesting way to think about the role of money, who controls how much money is in the economy. But there are certainly challenges to it. And Krugman's argument about it is that last thing I mentioned, that debt doesn't matter, you just issue more dollars and you pay back the debt. What his point is that, well, that's just inflationary. And we're not a closed economy.
Right.
So the modern monetary theory, from my read on from the outside, is that one of the big weaknesses is it assumes we're a closed economy, we control our currency, you just print more money and you pay back the debt, but the debt's held by people outside of the economy.
Exactly.
And it's not a closed system. So it kind of works in theory if you're a closed system, but if you need to pay back China, and they don't want to buy your debt because you issue more dollars, which makes the dollar plummet, they're not going to hold our debt, right? So who's going to buy the debt? Who's going to finance future consumption if no one wants our debt? Interest rates spike up, and the whole argument falls apart. So I mentioned that both sides of the aisle might kind of like the idea for their own reasons. It's tempting to make these arguments. But the mainstream economists don't think it makes sense because of inflation, and we're not a closed economy under most scenarios. So here's the third side of the argument where you might start hearing people talking about modern monetary theory. And there's this hedge fund called Bridgewater, and I read every day they send out little notices, observers, and I read them in the morning. And today they actually talked a little bit about this indirectly. And what they were talking about is, okay, so if we go into a recession, what can the Federal Reserve do? Because we've already had two stages, two different types of stimulus. The first is we cut interest rates to zero, right? Okay, so that has a limit. Can't really go negative. I mean, you can, but what happens if you go negative? The second thing was quantitative easing. Remember that, QE? Quantitative easing is when the government goes out and buys bonds to lower long-term interest rates and push the economy. The Treasury does. I said the government. The Federal Reserve does. What's the third step? What's the third leg if we want to stimulate the economy?
Lower taxes.
Spending. Right? So it's traditional Keynesian economics of fiscal stimulus through spending or lowering taxes. Either way, running a deficit. Running a deficit for the government to push more money into the system. So that third leg is essentially modern monetary theory, without necessarily arguing that debt isn't important and all that other stuff. But it's a way to stimulate the economy when interest rates are zero and you have slow growth. So what some economists are saying is, okay, this modern monetary theory might make sense when you're in certain unique environments, zero interest rates, sluggish growth, but it doesn't make sense 95% of the time. So don't adopt it as a long-term policy, but maybe you want to use it when you want to stimulate the economy in a unique environment. So that's another reason you might hear this argument going forward, though those people wouldn't call it modern monetary theory. They might just call it Keynesian economics or stimulating the economy.
Isn't it basically shifting the responsibility from the elites to the proletariat?
You mean if the Federal Reserve doesn't control it?
And now the Federal Reserve is elite economists making decisions and then shifting it over to elected officials. And that's really dangerous.
Well,
I mean, one could say one is better than the other.
Well, so that's an interesting political argument. And should unelected people control this? And there's a certain part of the population that hates the Fed and says they're not elected and they're not, what's the oversight on them? And I didn't tell them to do it. Right? I didn't elect them and put them in place. I want my representatives to do it. So there is that argument. And then there's the other argument that says we can't pass a budget today, let alone let the legislature try to control monetary policy on a quarter-to-quarter basis. Like, do you think they could actually do it? Does our system allow for people to actually make quick, timely decisions? Our system of separating three branches of government is meant to slow things down, and it's very successful at that, right? Yeah. So that movement from a few to many making the decision, people can argue that's a good thing or a bad thing. Another thing pushing this is the concept that monetary policy should do something for people. And when the Fed lowers interest rates, capital markets do well, a certain part of the population wins, right? If you're an asset owner, if you have a job, you do well, right? If you're not an asset owner, if you don't have wealth going up, and you don't have a job, you don't do well. So there's a big part of the population that feels very disconnected from actions of the Federal Reserve and saying, why doesn't my politician do something about this? So that's another, political angle to this, with the perception that traditional economics isn't helping the average person, right? We all see the political implications of that over the last several years. So that's a little bit on modern monetary theory. You might be hearing about it more as we run up to the election, because I think certain political factions are going to be making this argument.
Thanks.
That's interesting.
Very much appreciated.
Yeah.
So moving on to first quarter 2019 performance for your portfolio. I will start on slide 14 of the summary presentation. So as Greg noted, your portfolio very much benefited from the rebound in the capital markets in the first quarter. And we'll see that come through. So this is what happened in the first quarter, but also the trailing year still looks kind of underwhelming. Obviously that fourth quarter drawdown had a big influence on the fiscal year-to-date return. So the one-year return for your portfolio is positive, but below benchmark and about 1-ish%. So underwhelming on an absolute basis compared to what we've become accustomed to of double-digit fiscal year returns, which we will see as well. Starting at slide 14, where the actual asset allocation of the portfolio was at the end of the quarter, right in line with target asset allocation, as you would expect. About 40% of the portfolio, the largest slug in domestic equity. So overall, between domestic equity, international equity, and domestic real estate, about 80% of the portfolio in growth, 20% in bonds. Not much of a change over the last 5 years. There was one change in 2016 to bring the bond allocation down a bit, but generally pretty steady and always right on target. That's shown on slide 15, looking at that 5-year look back of the asset allocation of the portfolio on the top chart and the target over time over the last 5 years. We always include slide 16, and if you'll remember at the last meeting, we included this chart in the discussion of what asset classes and what asset categories might you want to consider in looking at the asset liability study in the coming months. So on the right side, or on the left side of the page, showing the asset allocations with the green dot, those are your asset allocations, the portfolio, or the allocation of your portfolio to each asset class. The gray distribution, and on the right side, asset categories that other plan sponsors, other public plans include in their portfolios, and where there's not a green dot, you don't have an allocation. The gray distribution represents that peer group, so other public plans that you're being compared to. You have a higher allocation to public equity, as Greg noted, and as we talk about each quarter, about 24th percentile for domestic equity, and in the top decile for international equity. On the lower end for fixed income, so in the 75th percentile or the third quartile of that peer group distribution for allocation to fixed income. Now, as you know, at the next meeting, we'll be doing education, further education on private equity, real assets, and real estate debt. The private equity and real assets categories are on the far right of that page. And I always like to look at the bottom number, the percent of the group invested. So about 30% of peers public plan peers have an allocation to private equity. About 25% of public plan peers have an allocation to real assets that's not real estate. So not the majority of peers have allocations there, but some do. Slide 17 looks at the assets over the quarter within the plan. So you started with about $476 million at the end of the 2018 calendar year. You're up above $500 million as of the end of the quarter. So saw almost $45 million in gains over the course of the quarter. Now remember, in the fourth quarter, we saw a strong capital market loss, which translated to about $51 million in losses for your portfolio. So made up the majority of that in the rebound in the first quarter. Not quite all of it. We saw another positive month in April, so I think I looked back and as of the end of March, the portfolio was at $519 million. That's just about where we were at the end of June 2018. So we had a big drawdown, a big jump back. Benefit payments continue to be paid out along the way. And from an asset value perspective, we're right about where we were at midway through last year.
How's that gonna affect our, we have our target of, is it 6%? And so we're flat. I mean, what's the implications of this? I mean, we're not 6% ahead of where we were. So what's gonna be the long-term implications of this?
So are you talking about our actuarial expected rate of return of 7%?
7%.
So if we
We're
end the
flat.
fiscal year below that number, there will be an actuarial loss due to lower than expected investment returns, but we smooth that over a 5-year period. And that will be offset in part by prior years where we had greater than expected returns. So long run, not much of an impact unless over the long run, we don't meet that 7%. So.
I know we're going back here, but on page 16, it's showing that we're in the top, I guess, 5th percentile of people, or funds that have funding in international equity. I don't remember us really discussing that a whole lot, about the fact that we're really kind of out there on the international equity side. I mean, I've always understood that we were kind of at the leading edge in the top 25 percentile for domestic equities. Is our large play in international equities because we have a large play in domestic equities? Are we trying to balance those two out, or?
Yeah, so the international equity does jump out. We've got a lot of that. And domestic equity, you're in the top quartile. You mentioned that. And there's certain plans that, for their own reasons, don't invest much in international equity at all. And if you're really conservative, you might be just US stocks, US bonds. So there's certain plans that don't have international equity but have a really high domestic equity allocation, right? But most of the plans, if you look at the median plan, it would have 10% less and 8% less in US equity, and 8% less in international equity, and then a bunch of other stuff, right? And the other stuff is what Claire was talking about, whether it's private real assets, private equity, international fixed income, or domestic fixed income.
So I see farther the chart, there's a few other alternatives that are international investments. So I guess we're just lumping our international investments in international publicly traded stocks, it looks like.
Yes.
That's true.
Yes. I'm not explaining what I'm trying to say very well, but let's say there are 3 categories of investors. Someone who wants just US stocks and bonds. There's that bucket. There aren't many of them, though.
Kind
So-
of a balanced fund.
Yeah, so for them, it would look like you have a lot of international equity relative to that subset. And then there's another subset that has a lot of other things, alternatives, and not a lot of public equity. And against that subset, it looks like you have a lot of both US stocks and international equity. And in this group, we're comparing you against both of those buckets of investors within the total public plan universe.
So of investors, of public plans that invest in both US and non-US stocks, your allocations are pretty typical.
Yeah.
But there are public plans that don't invest in international stocks, which then makes your allocation to international stock, or invest very little in international stocks, which make your allocations to international look inflated versus that domestic allocation.
What you just said, Claire, I'm looking at the percent of group invested, and it says 96.43, so that's saying a lot of people invest in international equity, but not very much.
Yeah.
Also, if I may, Madam Chair, throw in there, 96.4% are invested in international, but there's another 11% that are invested in global equities, which is
Yeah.
kind of another slug of you're getting international equity exposure there. So if you add that in, we're probably not as far out of line as it might appear there, just when you're looking at international equity only, so.
Yeah, one other thing that just jumped to mind is the width of the distribution. The distribution of allocations to international stocks, while much broader than that to cash, is narrow compared to that for domestic equity. So those ranges are, so the number of 5 versus 24, to me, both of those are high. So my bigger conclusion is the allocation to public equity is high. Any other questions? Looking at slide 18, we have performance for the total plan as of the end of the quarter. Performance for the last quarter, again, was excellent. Up over 9%, outperforming the target and in the top decile of top quartile of peers, 14th percentile versus peers. So a very strong rebound. You underperformed peers in your benchmark in the fourth quarter, and then outperformed as expected, given the return of the capital markets. Now, as we noted, the last year still remains underwhelming, about 1.5% positive return, but the total plan benchmark was up over 4%, and that landed in the bottom quartile, bottom decile of the peer group. Anything longer, still very strong. From an absolute perspective in general, returns across the board are positive. James, you were just talking about the expected return on assets being about 7%. Well, over the last 7 years, you've earned about 7.8%, so outperforming that expected return on assets on an annualized basis. So right in line there. Now, over the last 10 years, up about 10.6%. That is a very strong annualized return, ahead of the, right in line with total fund benchmark performance. Now, remember we rolled off 2008 as we rolled on 2018. So we rolled on a negative year, but much less negative than the 2008 year return. What strikes me is now we start to roll off 2009, which was a very strong positive return. I think this program was up over 20% in 2009. So depending on what happens in 2019, that'll shift that 10-year return a bit as well. So something to keep an eye on, just remembering kind of what goes into those longer term numbers. The longest return we have is 14 3/4 years. So that's the longest history that we have. Excitingly, we will be at around 15 next year, next quarter. So we'll hold that steady and can roll out beyond that. But over the longest history, that 14 3/4 years, up over 7% again. So outpacing that expected return on assets, right in line with that. We have fiscal year returns on 19 and 20. As you know, you tend to be at the top or the bottom of the peer group distribution from a fiscal year perspective. Fiscal year to date 2019, you're at the bottom, a positive return, but not quite 1%. We'll see how that rounds out in the next couple months. Fiscal year 2018, 2017, excellent. 2016 was bottom quartile. 2015 about median. And then excellent returns with the exception of fiscal year 2012, shown on slide 20. So the two negative fiscal years were 2012 and 2016, and it strikes me that all the others are very strong. So double-digit positive returns. This program has been very successful over the last 10 years, very much benefiting from the rise in the capital markets. 21 and 22, looking at longer-term cumulative returns and then the relationship between risk and return. You have outperformed over the long-term history versus just a passive index implementation of your target. That's what we're looking at on 21. If you invested a dollar in 2004, you'd have about $2.85 today versus $2.60 if you just use index funds to implement your target. So that tells us that your active managers in aggregate over time have added value. I'll skip to slide 23. 23 and 24 look at performance for each of the individual managers in the investment program. 23 in particular captures all of the domestic equity manager returns, which are almost all double digit. There are two negative returns on the page for the trailing year, and that's within two of the smaller cap value managers, so mid cap value, small cap value. Greg noted that growth has outperformed. Your managers have growth tilt, and the managers that you've hired in each category stay true to their style. So value managers have tended to lag as they are true value managers. Your growth managers have outperformed as they are deeper growth managers typically. Over the last 10 years, double-digit returns across the board. Slide 24 captures international equity managers, your domestic fixed income managers, and the real estate program with, again, the total fund returns at the bottom. International equity has been the most challenging category for this program, and it continues to be. It was a great quarter, up over 10%, outperforming the benchmark for the recent quarter, but the last year is still disappointing. Trailing year return down 8.5% versus a negative 3.7% return for the benchmark. So when we think about the managers that are in that asset category, the developed market managers are at the top. So Euro-Pacific Growth, Harbor, Oakmark, those managers are more volatile, so they'll take bigger bets. We expect them to outperform by a lot and then underperform by a lot when they're out of favor. Mondrian, on the other hand, is a more defensive manager, so they've actually been underwhelming in strong up markets. They did protect well in the fourth quarter of last year, which is playing the role that we put it in there for, being that protection on the downside, the less volatile part of that implementation. And then you have dedicated allocations to international small cap with T. Rowe Price and emerging markets with Investec. Both of those managers did very well in the recent quarter, up over 11%, almost 12%. Domestic fixed income is implemented with two managers, Dodge & Cox and PIMCO. They remain very good complements, and that implementation has done well in the near term and the longer term. In the recent quarter, they added 3.2%. That's outperforming the about 3% return of the benchmark. Longer term returns, pretty similar to each other despite the fact that they take very different approaches. So that's why we think they're good complements to each other. And then real estate was the one positive asset category in the fourth quarter. Now it turned in another positive return, but the lowest absolute return of the program for the recent quarter. So up 1.7%, up 6.7% for the trailing year. 2 managers implemented their reef and bearings. Bearings having been a bit more conservative, so their returns are lower than those of reefs. But both managers now seeing more of their return come from income than appreciation. Reef in particular certainly benefited from the rise in real estate appreciation. Bearings less so. Now both of them are seeing more of their income from, more of their return come from income than appreciation. So a shift in the market, but back to more what we'd expect. And then again, total fund returns captured at the bottom. The remainder of the pages look at each individual asset category, and then we have some additional detail for international managers. So most of this I've already said, but just quickly on slide 25, the domestic equity composite again has done very well, both in absolute terms versus its benchmark and versus peers, so the domestic equity implementations of other public plans. Over the trailing 10-year period, up 16% annualized, so adding strong returns for the program overall, bookended in the recent quarter by a 14% return. A couple quarters ago, we talked about Callan's capital market projections. Our outlook, our 10-year outlook for domestic equity is 7.15%, so much lower than that 16% return that's been experienced over the trailing 10 years. Now, 10 years ago, I don't think we expected 16% either, but just to level set expectations, 16% is a great outcome. 26 turns to the international equity composite. Again, an excellent quarter, up over 10%, outperforming the benchmark very well versus the international equity composites of other public plans. Anything longer term is less exciting. So a very underwhelming trailing year, down 8.5%, as I mentioned before, bottom quartile of peers. More median-like when you get out to 10 years, but underperforming the benchmark across the board for the most part. 2018 in particular was a very challenging year for the international equity composite. And then we have a set of pages that kind of go through one by one the managers in the international equity composite. I talked about most of them. The first 3 pages, Euro-Pacific growth, an excellent quarter versus other peers, has done well over the longer term as well. Did trail in 2018. So that does weigh on near-term performance. They do have a growth tilt, that's been a tailwind for them. But overall, they've done well versus their benchmark and peers.
Hey Claire, you mentioned earlier that our active managers are adding value for us. I'm trying to reconcile that with when I'm looking at page 16 of the full report, which has the attribution.
Okay. Yeah.
And there I'm seeing the 5-year attribution. There you're telling me that the manager effect is 2/3% drag on our portfolio. How do I reconcile that with your statement that the active managers are adding value?
Yes. So key point is time period. On slide 21, where I was talking about the added value by active managers, that is over 15 years.
Okay.
So it is a longer time period. Over the trailing 5 years in aggregate, they have detracted.
Okay. Could we see the attribution for that longer time period? Because that would.
Yes.
Okay.
So that's actually, we requested that the 10-year period be added, and we'll have that next quarter.
Okay.
When we hit the 10 years of Callan calculated returns will add
Okay,
attribution for 10 years.
understood.
So for clarification, that'd be attributing it to, how much gets attributed to each of the managers?
So is that level of detail available? Because I don't know if I've seen that before where you attribute it, so here,
To individual managers?
yes, or is it just an aggregate manager
It'll be
effect
by
asset
asset
allocation?
category.
Okay.
So domestic equity in aggregate, international equity in aggregate, fixed income in aggregate, and real estate in
Okay.
aggregate. Are you sleuthing something?
No, I was pulling my eyes back because I can't read these reports anymore. I have them at home, but the international equity over that 5-year period is the main detractor. And that's our pain point. And 2016 was a particular tough year for the active managers. So when we look at that 5-year snapshot, 2016 is having a big influence on it. And that's why the longer time periods that amortize that loss over a greater time period still looks look better.
And the most recent fiscal year.
And the most recent fiscal year, yeah. Yeah, so we'll get the 10-year numbers.
Okay.
Slides 28, 29, look at performance for Harbor International, Oakmark International. Oakmark in particular, Harris is the sub-advisor for this mandate. And it's a very volatile strategy, so they're benchmark agnostic. They don't look at how much they underperform or outperform in a given quarter and what's in the benchmark. This strategy requires a lot of patience, and I think over time they have done very well. So the trailing 10-year period, they're 10th in the peer group. They've outperformed by a very strong margin, but any given year can be pretty painful. So last year in particular, they were down 14%, the benchmark was down 3.7. That is weighing very much on near-term returns. We'd like to see them have a strong outperformance in the near term to make that up, but they're really focused on those longer-term 5, 7, and 10-year numbers. The 7 and 10-year numbers particularly good, but near-term results are tough to look at. They are painful. On the other side of that is Mondrian, who we mentioned before. They're in the structure to balance some of that aggressive allocation from managers like Harris, like Oakmark. Mondrian is a manager that does protect us in down markets. They trail in up markets, and so they don't look great versus peers in a strong up market, but as we saw in the fourth quarter, they should protect some of that volatility for the total international equity implementation. And then the last two are T. Rowe Price International Small Cap. Had an excellent quarter. Absolute returns have been additive to the overall asset category, and InvestTech, the emerging market dedicated emerging markets manager, up also about 11%, an excellent return for the quarter, matching its benchmark for the trailing year, but firmly negative returns, which is consistent with broad international returns for the year. Fixed income continues to perform well for this program. As I mentioned, Dodge and Cox and PIMCO are the two underlying managers. Solid returns on an absolute and relative basis across the board there. And then lastly, the real estate composite, which we did talk about as well, up about 1.7% for the quarter. Trailing 10 years, 11% annualized return, so definitely adding value to the overall bottom line for the program over the long term. Are there any questions on performance for the quarter? Obviously, we are going to be talking about potential asset allocation changes in the next meetings. But as we look back, it was overall a good quarter. We do have an update for April. I don't know if that went out already. We have hard copies if anyone wants to see them.
Yeah, we just got this report done yesterday, so it may not be,
We did
It's
get it on
supposed
the
to-
website, yes.
oh, you did, okay, so I don't know if you want hard copy.
So the bottom line is it was a strong month, another positive month, obviously. Volatility has picked up again in May. But for the month of April alone, the program plan was up 2.6%, which outperformed the target, which was up 2.3%. Fiscal year to date now at a positive 3.6%. So as of the end of the quarter, it was 1.6, I believe. We just looked at it, up to 3.5, 3.6%, but still trailing the total fund benchmark. That's including flat returns for real estate. So that will be updated as we go forward.
So, in summary, the performance has been strong in absolute terms. 3 of your 4 composites are doing well. International equity, long-term numbers are disappointing. Part of that has to do with, recall we got rid of that, the Janus Overseas Fund too, that is impacting our 3-year numbers. But 3 out of the 4 are doing well, 1 out of the 4 isn't doing well. If we get 66% right, that's our goal, right? That's what good investors do, consistently over time. And then they make sure they don't, that 1/3 they get wrong, make sure it doesn't leave a hole in the portfolio. That's kind of our strategy. That's what we want to do. One other side point is, Claire mentioned that your value managers, if you look at your 3 dedicated U.S. equity value managers, all 3 are underperforming. So that to me is kind of indicative that there's something going on in the market here. And we don't want to overreact to that. When everyone in a certain category isn't doing well, you don't want to overreact to their short-term performance. Having said that, Prudential, the small cap value manager, is someone that we're more critical of than anyone else in your investment program right now. And Claire and I have 2 meetings with them in the coming months. And so we want to make sure we dig into that portfolio, know what's going on, because to us, that's the one that is the most disappointing due to the magnitude of underperformance. We just want to make sure we understand what's going on there. So we'll follow up with that. I think that's all we had for you today.
Okay,
I have a question.
yeah.
Thank you, Madam Chair. China.
I do. Anything going on there?
Specific, and my question is strategically, not what's happening in the past few days in the market, but strategically, what are your thoughts about China? Several of us were at Sackers last week and heard some discussion about China specifically, and the changes that are coming with China A shares and the increasing exposure to Chinese markets that will be included in our indices.
Yeah.
And especially right now with all the turmoil, I mean, you know, you go ask your financial advisor when the stock market goes down a little bit, and they're going to tell you, I just got you the opportunity to buy things at a discount. Is that the line that you would give us here with China being off so much because of the trade wars right now? Is it a good time to be thinking about China long term? So strategically, what are your thoughts on China and the continued development of the Chinese stock markets and what that means for us and as an international investor?
Yeah, so we've been doing a good amount of work on China A. I think we're one of the few consultants with a database of China A product and peer groups. I hope I don't get this wrong, but what China A means is that you buy companies listed in China as opposed to buying shares in Hong Kong or companies that have indirect exposure to China. So now we as US investors can start investing directly in Chinese companies listed in China, just like we can invest in British companies listed on the London Stock Exchange. And with the China A shares, they're subject to restrictions. There are a lot of projections that say that that market is going to explode in size and market capitalization. So the investable universe is going to go up a lot. In the long run, US investors are going to increase their exposure to China and the direct China market, China A. And some of your managers can do it for you, but if at some point you need to measure, okay, am I still underinvested to this market? And can I get the amount of the exposure I want? And do the managers I work with actually have boots on the ground in China looking at the 5,000 companies that one could invest in there, or are they just investing in the large tech names that you may have heard of before? So I think there's more work to do there, and in the long run, I think your exposure to that market will be increasing. And as a owner of capital, you don't like the idea of tariffs punishing the value of Chinese stocks in the long run, right? Nor do you like tariffs beating the value of US stocks, which export goods to China. But in the very long run, China is going to be the largest economy in the world, and you probably want to be there to invest in the companies that are taking advantage of that economy. It will be bigger than the U.S. Might be 20 years from now, but it will be someday.
Would it be fair to describe China's economic system as operating under the new monetary system?
Oh, modern monetary theory?
Modern monetary theory?
I'm not good enough on economics to draw all those conclusions, but it is a control economy. The government spends money when it wants to spend money. It has a fixed currency rate. So there are some similarities. And as an aside, some people say the modern monetary theory proponents want to move to a control economy. That's, one argument some people make, that this is just a smokescreen to get to a control economy. I think that's
I'm shocked.
Yeah. Though I do think that there's an academic argument component that is distinct from it being a control economy. But yeah, there's some similarities to it.
Brendan, go ahead.
Oh, sorry. The number that I remember from the presentation last week about China was, and I may not get it exactly right, but something along the lines of China shares are currently 3% of the ACWI index, and in 5 years' time they'll be something like 15%. So there's going to be some really dramatic changes to the indices, and the investable universe in the next 5 years as it relates to China. And, that just started me thinking, are we positioned where we need to be? What does that mean? All these kinds of things. So I'm sure we'll have further conversations about that. But that was an interesting point to me, that it's a five-fold increase in the exposure in the index to China shares is going to be a massive change.
Wouldn't you, go ahead, sorry.
I was just thinking, if capital were to shift that dramatically to their market, would that also mean there'd be a corresponding removal of capital from European and US markets, equities?
It's got to come from somewhere.
From an investor's standpoint, implementing an international equity allocation, you think about the evolution of how investors have allocated capital within international equity. It wasn't that long ago that dedicated emerging markets allocations were a new topic. It used to be just investing in developed markets only. Emerging markets grew and were more accessible to a point where investors have dedicated allocations there. So a lot of the discussion is, at what point does China become commonly a dedicated allocation?
Yeah, and you mentioned, James, that in the broad international equity index is going to increase, but it's still going to be less than Japan or Europe. But if you also have a dedicated EM portfolio, and China could be a third or 50% of that someday. And so that one, we really got to keep a close eye, because that portfolio almost becomes a country fund, right? And your manager outperformance is what did you do in China, as opposed to what did you do in all the other countries in the world.
I think it's important to realize during the early phases of this, so that Shanghai is not Wall Street or London. I mean, they don't do business the same that we expect here. I have a relatives taking a company public in China, and it's just shaking his head at what goes on behind the scenes in that market. So it's a market that I would look at as the 1920s here.
Yeah.
Wow.
And then what's investor rights? As an investor, what's your right of
And
to own a
transparency
company?
and the truth.
Yeah, and accounting policy and reporting. Yeah, there's a risk control component about how much do you want EM to be emerging market equity in general, let alone China specific in your portfolio. Yeah.
I was talking to one of the members of our international equity research group a couple of years ago now about China, and he came up with the analogy of, we're on the diving board, we're gonna jump eventually, but at this point we can't quite see the bottom of the pool.
Okay,
We'll just sort of looking at the other end of the spectrum, the fixed income and the real estate, which seem to be relatively stable and not very variable. So looking over the 10 years, the fixed income has a return of about 5%, which is actually more than I think most people would have guessed. And the real estate's return of 11%. But they don't show any given quarter, the last quarter's not down, the last year's not down, it's very stable, both of them. And I guess the question would be, someone would look at that and say, well, why not just put more money in real estate and less money in fixed income if they're both relatively stable?
Oh, I see. So why not do that going forward?
Yeah, when we're looking at our asset allocation, it just seemed like sort of an obvious question to ask. There may be a brilliant answer as to why you wouldn't do that.
Yeah, and our answer would be do both. You have a comparatively low allocation to fixed income. 22, 25, 22. There's only so much you can take from there to put in somewhere else, but one could go to 20 and put a couple percent in something else. But much less than that. The one thing about fixed income is it's driven on treasury prices of treasury bonds, and that treasury bonds do remain the one flight to quality. If in 2008, if the we're pulling people out of Iraq today, right? Because of potential conflict with Iran, and You know, in that environment where everything goes south, treasuries are that one thing that'll do well for you. And even better than real estate, which still has, you know, some volatility associated with it.
Leland?
Well, in real estate, you separating debt from equity. Like our office building, it shows an appreciation of 7.5%, I think it was. And how do you get that when the rents go up 3% a year? Well, how does that magically happen? Well, because as the treasury bill goes down, that produces a lower capitalization rate, which then increases the value of the property. So as interest rates go up, that cap rate goes up, which then lowers the value of the building. So that 7+% appreciation is really 3% increase in rent and 4% just manipulation of the interest rate environment. Does that make sense?
So the real estate in returns of the last 10 years would not look so great had we had what have historically been considered normal interest rates. We've had historically low interest rates, so I guess
Over
that's...
the last 10 years. And also, in that 10-year number, you'll see that your returns plot outside of the distribution. And that's because, recall that 10-year number includes 09 with a huge rebound. It doesn't include 08 with the huge decline. And at that time, you also had REITs as a component to the real estate composite. So those are public companies which invest in real estate as opposed to you directly investing in real estate. REITs in 09 went down like this. 08, then 09 it came roaring back. So because you had that REIT allocation within your real estate portfolio, you got that huge return in that 10-year time period. And that's why your 10-year 10% return doesn't look like real estate. It doesn't look like the peer group during that time period. That's a long-winded way of saying we can't replicate that return based on investing in what we have today, which is direct real estate, which is less volatile.
Well, and I think the time period is also the start of the 10-year time period here is March of 09,
Yeah.
right? The absolute bottom of the global financial crisis.
Yeah.
So when you start at the bottom, it's real easy to look good.
Yeah.
So is there a reason why next quarter's report, what we have on page 33, 34, et cetera, is there some reason why they couldn't go beyond the 10-year? I mean,
Oh, yeah.
do you have the data to go beyond?
Yeah, we could show the 14 and
I mean, just trying to capture that 08 crash, so you're averaging out.
yeah. Yeah, we could
Even including calendar year returns to show them.
yeah, we could show a longer time period for the composites.
Yeah. Well, yeah, we should have 15 years.
Yes.
Okay.
Very good.
Any more comments, questions? No. Okay, well, thank you very much.
Okay, yeah, thanks. Great to see you.
Thank
Yep.
Thank you. Have a nice vacation.
Hey.
Somewhere fun?
I'm gonna drive cross country with my daughter. Yeah. So, we'll have a good road trip. Yeah.
So, are we ready for a 10-minute break? Yeah. Okay.
10-minute break it is.
Item. Discussion and possible action regarding resolution 2019-21 stating authorized and rescinded signatures.
Thank you, Madam Chair. Trustees, you have the proposed resolution before you. We would recommend approval. Get rid of that shady character, Stan Conwell, and add our new financial investment officer, Robert Ravelas. For those of you who have not met them, this is Robert.
Hi, Robert.
Giving him full authority to sign on our behalf. Happy to answer any questions you may have.
I'll move to approve, although we all know that Stan was a great employee.
Get that on the record. You just want to get that on the record.
Yes, Stan was a great employee. I was clearly joking, but for the record, Stan, you were a good employee.
I'll second the motion.
Okay. Are we, okay, all in favor?
Aye.
Aye.
Opposed? Okay. Abstain? No. Okay, motion passes. So, that was a motion, just to be clear, that was a motion saying that Stan was a good employee. or-
Adopted the resolution.
Okay.
Adopting the resolution
Okay,
as presented.
okay. So, do we have to sign here or later?
Yes, we'll sign that after the meeting.
Okay, momentarily. All right, okay. Discussion and possible action regarding fiscal year 2020 budget proposal.
Thank you, Madam Chair. Trustees, you have the budget proposal before you. It's been shared with all of you at least 2 weeks ago. I've had some back and forth with some trustees. I'm happy to answer any other questions that you may have. Would recommend adoption as presented.
Yeah,
I move the budget be adopted as proposed.
I'll second.
okay.
I have one question. It says overall the employer portion of the health insurance for MSR employees is increasing by 33%. Is this the county's health insurance?
This, so based on the information that we got from the auditor controller's office, the employer's cost for the health insurance is, I'm not sure why, 33% higher than it was last year. And that's at all of the different, that's at the single, that's at the covering the entire family, it's all the different levels that we see.
I'm just surprised by that because the healthcare plan has been so successful, it's been running under budget.
Right.
And so it would be interesting to see if this actually holds true for the year.
That's what the auditor gave us, and I'm not sure, so,
Okay.
yeah.
Okay, so, all those in favor?
Aye.
Opposed? Abstain? Motion passes, budget is approved, accepted. Next, discussion and possible action regarding audit and budget committee charter.
Thank you, Madam Chair. Trustees, as you've seen with the new budget approval process this year, things move very, very smoothly. In discussions with the board chair and the chair of the Audit and Budget Committee, we bring this to you as a proposal to amend the charter so that the Audit and Budget Committee would become the Audit Committee. I do have two other small changes to the charter that I will throw out there as amendments. On item number 4 on the first page, I did not catch that it still says retirement administrator, and I would suggest we change that to executive director, consistent with all our other language. And then the footnote at the bottom, or the footer at the bottom of page 2, I did not get the amended by the board date, so I would suggest that I make those amendments as well, to have that correspond with the footer on page 1.
Okay, do we have a motion?
I move to adopt as revised.
Second.
Any discussion on the motion? Okay, all those in favor?
Aye.
Opposed? Abstain? Motion passes. And we have adopted the new audit and budget Committee
audit
charter.
committee charter.
All right, so discussion and possible action regarding budget adoption policy.
Thank you, Madam Chair. Trustees, you have the proposed changes to the budget adoption policy before you. These changes align with the process that we've just been through and delete reference to the audit and budget committee and it codifies the process of sending it to the board for review individually. Additionally, at the top of page 2, I previously had proposed that we eliminate the listing of the specific categories here so that if we need to make changes over time, we have more flexibility to do so. And this just makes life a little bit easier for us if we ever need to make changes to our budget categories, so.
So I had some questions on that because it says it references the 37 Act categories. And I did attempt to find that in the almost 500-page document, but I couldn't find the categories listed. So it just says we're removing these categories, but we'll follow the 1937 Act, and I didn't see any there, so.
So specifically what the 37 Act states is a limit on administrative expenses, but I don't believe it defines what is administrative expenses, but it does say that it excludes technology and investment related expenses. But
From the point.
from
2.1
the
basis
definition of administrative expenses that the retirement, the 37 Act has a limit in. The 37 Act limit is the lesser, or is the greater of either $2 million or 21 basis points of your actuarial accrued liability. And for us, it is the $2 million because our actuarial accrued liability is below about $961 million right now. So $2 million is our statutory cap. Our policy cap in this policy is still the 21 basis points of the actuarial accrued liability. I probably said a whole lot more than I needed to there, but.
No, that all makes sense. I guess I'm just concerned about not seeing personnel broke out from all the different categories like we see now in the budget when it's submitted. Is it just going to be?
Oh, no, absolutely not.
Okay.
No. We're gonna continue to have categories. The concern I had with these specific categories listed is we used to not have board expense as a separate category. When we decided to break that out, we had to bring the policy back and have it amended by the board. Here, we're gonna continue to have categories, we just don't have to bring the policy if we see the need to create a new category.
Okay,
That's all this is.
thank you.
And it just in general says into various categories to facilitate comparison.
Correct.
I move for adoption.
I have a couple more questions. I'm
Okay,
sorry. Just for clarification, as I'm learning. Section 4 on the capitalized expenditures, changing it from 5,000 to 25,000, as determined by the executive director if it would be capitalized or not. Just curious, what is the county policy, if there is any, for the determination of capitalizing those expenditures, and have we looked at that? Or is there any kind of direction here that we're following?
I do not know if there's a county policy on that.
I'm not opposed, I'm just curious, what's the value of increasing it to 25 and just making sure that we're following
I
a
wonder,
practice that's beneficial to the
yeah, I wonder if it
budget?
has something to do with the department heads have the ability to sign, like even contracts, 25,000 and
Right,
less.
that's a county.
Yeah, I mean, I wonder if it's just tied in, if that figure's tied into that departmental authority.
Yeah.
It could be.
I don't know, but I'm just
Who
guessing.
proposed the change and why, what, did they pick that number then?
I drafted the
Okay.
changes. I'm struggling to remember why I proposed this change, and it's not coming to me.
But it's not a change in authority to approve, it's just how you're recording it as a capital
And the amount,
Right.
expenditure.
5,000 to
Yeah.
25,000.
Yeah. And 5,000 is way too.
From
low.
10,000,
Right.
10,000 to
Yeah.
25,000, was it,
That's
or is that
the
the
next
one
one.
above?
No, that,
Oh, that's,
We're
oh, that
on
was
before.
5,000,
Same, both
okay.
of them,
Yeah.
yeah.
Yeah, 20,
The next one's changed.
Any more discussion?
I don't know if I sufficiently answered that question, Madam Chair.
Section number 5, the following one after that, I just had some confusion with the language. It grants the authority to shift the funds within a category instead of 10 to 25. But then it says it can't be moved from one category to another without approval. So one says that the executive director can move, and then the following sentence says it can't be done.
So
Unless I'm
it's,
misreading it.
it's moved within a category, but not across categories,
Okay,
is what that says.
okay.
So within, for example, the administrative category, there is the authority of, we need more money in this line item, and we don't need as much in this line item, so we need more in legal expenses and less in contracts. There's the authority to go over budget in one line item within that category if it's moving funds, but it does have to be recorded.
Thank you, that makes sense.
And what we've done typically is, when we see we're going over budget in a line item, we will bring a budget amendment, just to keep everyone aware so that we all know what's happening, so.
That's all I had, thank you.
Okay.
I'm not sure we clarified 4 though.
Yeah.
Because I made the motion, but I will take it back if we haven't clarified 4.
So I know I put that change there, I cannot recall why I put that change there. I think it was just aligning with
The next.
the next one.
Mhm.
But if it's an issue, we can strike that, it doesn't, I mean, I don't know that we really have.
It's not an issue for me, I just was curious, the reasoning for the increase and the benefit of capitalizing versus not capitalizing an expense, if there is any to the budget, so. I'm fine with the changes as they are, just curious.
There's not really much of a difference for us for capitalizing an expense. We're just different.
Just
We're not
determining it as a
appropriated.
fixed asset versus a non-fixed
Right.
asset, okay. Thank you. I'll make a motion to approve it with those.
We have a motion to approve. Would you like to second?
You can second.
I can second my
I think
own.
she, well,
Oh, she withdrew it,
Yeah.
okay, I'll second.
She said she would have withdrawn it
Oh,
if
she
you had,
would.
if you had changes, yeah.
Any more discussion? Okay, all those in favor?
Aye.
Opposed? Abstained? Motion passes to adopt the new budget.
Adoption policy, yes.
Okay, discussion and possible action regarding communication metrics. James?
Thank you, Madam Chair. Trustees, you have our first attempt at presenting you with some communication metrics. And if you were looking at an earlier version of this, I'd ask you to pull it up again because I made some changes over the weekend. Saw some things that needed some slight tweaking. So there are 3 sets of information that we're presenting for you here. First is related to the newsletter. So you can see so we distribute a newsletter every month to all of our members that have not, for which we have a valid email address, who have not selected to unsubscribe. So anyone that receives our newsletter can unsubscribe, and then we have to remove them from the list in the future. The dark line on this graphic shows you the total number of subscribers, and over time that has trended up. A little bit of a dip up front as we started the process, and then since then it has ticked up over time. And I will say, the subscription to the newsletter is open to anyone. We don't restrict it to just our membership. We do have an avenue on our website. If any member of the public wants to go and sign up for that, they can do so. And we have had that happen in some cases. The green line, the dark green line, is the rate at which the newsletter is opened. So someone actually opens the email. And you can see that we are north of 40% almost every month. And the light green line there, the comparative line, is the industry average open rate, and that's at 24.4%. So we're doing very well at getting at people opening our emails that have the newsletter. It seems to be very well read. The blue line is the click rate. So not only does someone open the email, but then they click on a link in that email to go read more information. And that obviously is much lower, as you would expect there. The next graphic shows you information related to our Member Direct accounts. The blue line is the number of Member Direct accounts created each month. And this is allowing online access for our members to get in and see their accounts and create retirement benefit estimates for themselves and those kinds of things. The black line, which is somewhat obstructed, is the total number of accounts created. So you can see we're now up to over 1,200 Member Direct accounts created in aggregate.
Congratulations, that's
We're
great.
very happy about that. And the green line, measured against the right scale, is the percentage of total members with a Member Direct account, just over 40% at this point. So, and Member Direct offers different benefits to actives versus retired members. Our active members can go in and see account balance and create a benefit estimate. Retired members can go in and see their benefit amount every month. They can change their tax withholding in Member Direct. They cannot change their banking information. We don't allow that in Member Direct, and that's a security issue. But there's different, the different membership groups do different things in Member Direct. But we're excited to see these going up. In the future, we'll be working on some other metrics around Member Direct, looking at number of transactions in Member Direct and those types of issues. So right now, we just wanted to get this in front of you. It's required by our communication strategy that we actually measure how we're doing with our communication efforts, so you see that here. Finally, you have information related to the county's 457 plan. This is not something that we have any control over at all, but we have been very consistently providing messaging to all of our members. Specifically, this is targeting active members to engage with the 457 plan and increase the amount you're saving in the 457 plan. So the blue line here is the rolling annual contributions. So it's the 12 months of contribution in history, and this is all monthly data that we're getting here. By doing the 12 months, we don't have to do any sort of seasonal adjustment. You just roll off a month and add a new month every month. The green line is the percentage of eligible employees that are contributing to the 457 plan for the county. We're not picking up any court data here. We're struggling with the courts just getting their transmittals sent to us, so I don't want to look at their 450s. I don't want to mess them up at all.
So 2 questions. James, are you saying that currently roughly 25% of the active employees are contributing something towards the 457?
Almost 25%, yes.
And then the other thing is, I know you and I talked about at some point incorporating a newsletter, like maybe an opportunity, maybe every other month or every quarter, because there's the 2 plans, to having those plan managers maybe write an article as to why would you want to invest in a 457 plan, and then kind of giving them a venue, but going back and forth between the two in our newsletter.
We've talked about that. We don't know who the Mass Mutual representative is.
Okay.
What is that plan, the other one?
So there's two plans that the county offers. There's a Mass Mutual plan, and then there's a CalPERS plan. It's a CalPERS branded plan. It's actually administered by Voya. The former rep for Mass Mutual now works for Voya on the CalPERS plan. And Mass Mutual had a rep, and then we don't know what happened, and so now no one knows who the Mass Mutual rep is.
Is Mass Mutual another 457?
Yes,
Yeah.
That was the
yes,
first one that the county ever had. It
Yes.
used to be Hartford, and then it was bought out by Mass Mutual.
yeah, sorry.
Nationwide.
Nationwide.
Two separate plans.
Well, we had two others that got taken, but we had two others that were removed, right? We can't invest in those anymore nationwide.
Nationwide was one that they could roll over.
And what was the other
Massachusetts.
one?
I can't
There was another one too. We
But
had
this includes all of them.
This includes both,
Both.
yes.
two, we have two now. We had three before. Two of those were kicked out and one new one came in.
And the reason it was kicked out
It's
is
because Dan-
because CalPERS had a cheaper,
Yeah.
lower fee plan.
Right.
And when the other two plans, the three plans learned that CalPERS was going to be offered by the county, coincidentally, they all three offered to lower their fees.
You can see in the graphic exactly when the new plans came on board, the dramatic decrease in the contributor rate at the end of 2015. That is when the changeover happened. And you can see that since then, the contributor rate has ticked up, as have the contribution amounts. You will see these little spikes periodically in the blue line, the contribution amounts. What we see happening quite a bit is someone will be leaving county service for whatever reason, either moving to a new position or retiring, and they will be getting paid for all of their accrued leave, and they will direct a lot of that into the 457, so you get a very large spike in the contributions for a 1 month period, so.
And if I may, is a conversation, I think it's what Dan's saying as well, that I had with you regarding the newer Pepper members for safety, because they are not going to receive a COLA when they
Right.
retire. And it's important to communicate to them that they need to do something to take care of themselves after they retire. And I think that an increased communication to them, I don't know if it's via email or what, would be beneficial.
Yeah, we have included articles in the newsletter in the past about that issue. Every time we do a seminar, the Retirement 101, I am hammering that point. And we, when we arrange our biannual Retirement 101s, we have representatives from the 457 plans there.
Okay.
And they actually talk to the entire assembled group, and here's what we have and here's what we do. We really try to make it easy for you. Payroll deduction, all of it. And they'll stay as long as members want them to answer questions and help with forms or whatever. So,
You know, my fear is that it may be, I know the generation, and it may be getting lost in the newsletter. And especially with reference to the click rate that is in the study, I don't think that they're actually going through that, and it might be getting lost. And I think we can work
Okay.
together and hopefully do that for them.
Is it something that's included in the employee orientation? I know it's a 3-dayer now, so.
the 457?
Yeah, so
Oh.
here's a form, a little presentation, so they can touch them as they come into the
Oh, it
county.
should be.
So, yes, a little bit, but the problem there in orientation is that you've got the different bargaining units, and it can take a lot of time to work with one individual on the 457s. So when I was over there doing that orientation, I would kind of give them a real general, do we have any managers, department heads, you get this, everybody else, you get that. If you have any other questions, come talk to me after the fact. So there's not a lot of time there to do it because you've got maybe 10 people. Sometimes there's only a few people there. So it is a conversation that does happen over there, but you know, in terms of the follow-up that I had when I was there, maybe 2 people though in 6 months.
Yes,
Maybe, I know that during the 3-day orientation that they do show some videos where they're pre-recorded, obviously, and that maybe that would be an opportunity if we could convince HR to allocate 5 minutes. And maybe it's not us, maybe it's the two plans get 3 minutes each to just give a pitch about why you would want to set aside some money into a 457.
The other thing is they have a table at the annual thing out in the hallway. You know, we have the annual thing.
Benefit fair?
Benefit fair. They do each have, typically, I think they each have a table there for the employees, which maybe they won't be dealing with so much new stuff as they would a new employee. So I think that's really good that they're there.
I know at our department, they'll send out emails regularly. I think it's about once a year that the rep, whoever that is, will come by and they'll send out an email saying anybody that wants to talk to them about their current withholdings or future or additional withholdings can come meet with that rep during those dates. But that's department specific, I'm assuming.
Well, our department has that as well,
Yeah.
so probably
Yeah.
I will say that having 25% of the eligible members contributing, it may not seem like that's very good, but I think if you compare us to other plans, I think we're doing pretty well. I mean, I don't have any comparison points on that, but I think that's a pretty healthy number. Yes, we definitely want to see it higher, but that's a pretty healthy number.
Yes,
The number one way they're gonna get that to increase, if they really wanna do that, is to offer matching for SEIU 101. This is 25% because of them essentially. The other bargaining units that have match are above 50%. So once you get SEIU 101, that's when you see this.
K-Dan?
Right?
Get that printing press running.
Make that happen, yeah.
What's that new theory?
Modern monetary.
Modern
voluntary.
Mendocino theory.
That's a good point, though. That's a good point.
So, I'd be happy to answer any other questions. If you have thoughts or things you think we need to be including here or other things you want to see, feel free to let me know. You can shoot questions or daggers at me now, or you can email me later at your convenience.
I want to say thank you, James, for meeting with our two new supervisors. I believe you met with both of them and as well as the Willits Rotary, so I think those kind of communication outreaches are valuable for us too, so thank you.
okay. Next, we would like to move to the administrative report.
Thank you, Madam Chair. Trustees, you have the administrative report before you. Hopefully, you've all seen the email with the information regarding the evaluation. The chair asked that you please get the information to her by June 1st, if not earlier. The legislative update is attached. I do want to briefly touch on one item in the legislative report, and that's Senate Bill 783. It is I believe it's called a spot bill here, what I know as a shell bill. There is no substantive language in that. That is being crafted by, it's been crafted by the chairs of the SACRS Legislative Committee. And the intent is to include in that bill technical corrections of the 37 Act. And they've begun putting together a list of items that they see that are of a technical nature only, so they're non-controversial issues. And it's already passed out of the Senate. It's now in the House, where I think the House side, where it will be held until next year. Once they've given sufficient time for input and feedback from all the 37 Act plans, they will draft a bill and then run it through the SACRS legislative process, bring it before the systems in the fall, hoping that the legislative committee and full SACRS body will support the measure, and that it can be passed next year to start trying to clean up the labyrinth that is the 37 Act.
What's an example of an error?
So it's just a technical. So there are some sections that have references to other code sections that are inaccurate. So it's fixing those kinds of issues. But there are other examples One that was discussed at the SACRS conference was there is a provision in the 37 Act that we can only accept a retirement application up to 60 days before your retirement date. No compelling reason for the 60-day limit. There is a compelling reason for some limit, but the proposal that was talked about was eliminating that, but giving each system the ability to set its own limit based on its business needs. So that's in the works. If you have any, if you're perusing the 37 Act late on a Friday night and see something that's confusing you think we should address, feel free to shoot me an email or a text, and we can have a discussion. So.
Thank you.
It's probably about the 5th time this has been done since I've been around. Complete overhaul.
This is not an attempt to undertake a complete overhaul. It's just an attempt to make some technical corrections. The SACRS Legislative Committee is in a different place than it has been historically. I don't know if it's always been this way, but the chair, typically, or as long as I've been around, the chair of the Legislative Committee is the administrator of the Sacramento County Employees Retirement Association system. I don't know which one it is. Association. System.
Eric Stern.
Yeah, Eric Stern. It was Richard Stensrud before that, because they are right there near the legislature. Eric Stern is the new retirement administrator there, and he worked with the legislature extensively and is very familiar with the legislative process and is much more wants to engage in that process. So this is a first attempt to start making some things better for all of us proactively through legislation.
I thought they had turned this over to a retiree from the LA County Council's office.
Dave Muir, they were trying to like rewrite it and reorganize it to make it a little bit more readable, but it sounds like, I mean, that was gonna be an extensive, and I think they're trying to take some of the major pieces now and fix that.
I'd be happy to answer any other questions on the administrative report.
Well, if there are no other questions, I believe we can move to adjourn. And
Do we have board member, general board member
Yeah.
discussion?
oh, I'm sorry. Okay, yes, general board member discussion. Excuse me. Sorry.
Just quickly, I emailed Lloyd, our auditor, about the question about why the insurance rate was going up 33%, because I do know the plan's doing pretty well. And he just brought back that, that for the last 2 years, both the employees and the employer have had a kind of contribution holiday for 2 months of the year, or
3 months.
3 months of the year for the last 2 years, because the plan was sufficiently funded. And their budget assumption is that that's not, they can't do that next year.
Okay.
And so it's really just a matter of not having that holiday of contribution, at least on the employer side so far.
Okay.
So, I don't know if I missed something, but could you please introduce our new fiscal person?
Yes. This is Robert Ravelis joining us in the peanut gallery here. He is our new financial investment officer. He comes to us from the auditor controller's office, where he was working as an accountant, working primarily on the county payroll. Before that, he was with Health and Human Services. He's got a very interesting background. He's a local from Ukiah, went away to college at Rensselaer Polytech in upstate New York. For those of you that aren't aware of RPI, it was a very good school, and managed to get a degree in physics, and then decided that he wanted to come back here and not much to do with the physics degree here, so numbers, he's really a numbers guy, is what I would say. So I've jokingly said we have our own rocket scientist now, but he corrected me that he didn't really do that side. He was much more on the astrophysics side in getting his degree. So we have our own astrophysicist now, I guess I'll say. We're happy he's here. He's been on the job 2.5 weeks now, and is just jumping right in and getting everything figured out, learning the job, and just cranking on the output. So we're very happy he's here. If you have not met Robert before, please introduce yourself. He has watched a number of these videos, so he's seen all of our arguments and everything else we've gone through. And we're excited to have him. He loves to learn new things, and I think I've got about 2 years worth of learning mapped out for him already. So we're excited he's here and can help us out and keep me from looking like the fool that I often am. So welcome, Robert. We're glad you're here. This is the board, the majority of them. So
Well,
my
thank you.
apologies. Yeah.
No, thank you very much. I'm excited that you're here, and hopefully you'll stay for a while.
That's the idea, yeah, I'm super excited too.
Okay, thank you. So I just want to say one thing about the conference that just ended. A few of you were there, and it was, in my opinion, I always think this, but I think it's the best one we've had so far. And I also want to say that we're having, we have an annual, like 4-day, I would say it's kind of a workshop. It's an investment presentation at UC Berkeley. And if anyone's interested, there's still time to sign up for it. It's very good. It's not like the Haas, well, it is the Haas Business School, but it's not like the Wharton in Pennsylvania, which is more, I haven't been to that one. Have you haven't either? No, I don't know. Has anybody here been to that one? I think that one's more academic, but this is interesting too, because you have, the one that I went to, the professors were, they're opinionated. And they would share their own opinions about various things, and so it's nice to get a cross-section. You went to the same one I went to.
You want to toss?
No, yeah.
Yeah.
Yeah, so it was like a cross-section of different instructors with strong opinions, some of them, which is, it's educational too, to have that. So, hopefully at some point, some of us will go to the Wharton instructional opportunity too. And that's it for me.
So, if I can piggyback on that, Madam Chair, this week Calipers released the agenda and the registration for the new trustee orientation, or not orientation, Principles of Pension Governance for Trustees course that is in late August at Pepperdine. And I sent that information to our 2 newest trustees. I know Kathy Smith went last year. If anybody else is interested in going to that, please let me know. I wasn't specifically excluding anyone. I was just targeting our brand new trustees. But if we have more than, so Calipers sets that up where every system can absolutely get 1 new trustee in, and they will take a second trustee as a backup. If we have 2 or more that want to go, I will make sure we all get in. I kind of have an in with that group. So.
Are you going to be presenting?
Yes, I'm on the faculty for that plan. I talk about, I do 2 things. I give a presentation on how a board should operate or function, and then I also do the case study, one of the case, not the disability case study, the other case study on dealing with difficulties as a board. So.
And I went last year and it was extremely beneficial.
You drive down or fly down?
Fly. You can drive, but that's a haul.
Well, hopefully, one of these days we'll get the honor of you also attending trustee breakout at the SACRS conference. Those are fundamental, basic things that new trustees need to have to orient. I had, at the trustee breakout this time at the SACRS conference, there were some people in the audience that were saying that they thought that trustees should get more education than 24 hours, that there should be a requirement for that. And, you know, bottom line is, there's nothing that if people don't get the education, there's nothing we can do. It's up to the individual. But there's certainly a lot of opportunities, and our budget has provided for that so that we can go if we want to. But I know some people, it is hard to just even to get away, to take out, you know, the time out of your regular schedule to go attend. But every time I've gone, it's been extremely valuable, yeah. So, okay, if there are no more discussion, if there's no more discussion, I'd like to, I need a motion to adjourn the meeting.
So moved.
Second?
Okay, all those in favor?
Aye.
Okay,
No, I wanna keep going.
meeting adjourned. The meeting is adjourned at 10:41.
Oh, I thought